Alright guys, welcome back to the channel. Now in the previous videos, we spoke about the psychology that is required in order to be profitable in forex. We spoke about risk to reward ratio. We spoke about what percentage of your account you should risk on every trade. And then we spoke about support, resistance, trend lines, and how price action works together with these. So what we're going to do today is we're going to put everything together. We're going to put together support, resistance, and trend lines. So I'm going to show you how it is that I analyze a chart for support and resistance, and also how price moves between this support, resistance, and trend line. So when I'm analyzing a chart, I start from the weekly time frame because the weekly time frame basically each candlestick tells you the movement of price over that entire week. And because it's a longer time period, it's more likely to remain consistent, that movement. So if you see movement here, this is one candle and this is 1 week. So this one candle, it means that the entire week this price was bullish. And the following week it was bullish, and so on and so forth. Means that if you took a trade at the bottom here, at the starting of that bullish momentum, you could have stayed in that trade and it could have lasted 1 week, 2 weeks, 3 weeks, 4 weeks, 5 weeks, 6 weeks. So the weekly time frame, the higher time frame, when prices showing a certain movement within that time frame, it's more likely to remain in that time frame. So if you see on the weekly, the price is bullish, that means for the previous week, price is bullish. There's a high probability that for the coming week, price is going to continue to be bullish. So we start off at the weekly time frames. So we see we have bullish momentum here, and we have a bullish trend line. So let's first start off with the support and resistance. Now, we said that support and resistance, it's basically an area, a horizontal area that price rejects. And if you can see, we have a nice area here. Whenever price comes to this area, when price is selling and it comes to this area, you have a reaction there, you have a rejection. It rejected it twice before it finally broke through the area. As we progress further, we move more to the right-hand side. We see once again, price came to that same area, but from below, and it rejected the area twice before selling all the way down. It came back to the area, once again, trying to break through it, wasn't able to do so, sold down, and so on and so forth. So this is a significant area of interest. And we call it an area of interest rather than just a support or a resistance because as price is selling down, it comes down to what we call a support. As price is moving upwards, it comes to a point that we call a resistance. This area is both a support and a resistance. So for simplicity, we just call it an area of interest. So an area of interest is an all-encompassing term. So there we have one area of interest. Now there are many more. We have another area of interest here. Because we can see price came to this area multiple times and we had a reaction. Had a reaction. So this is our other area of interest. No, it doesn't have to be perfect, but you want it to encompass the rejections. You want it to encompass not just the wicks that are formed, but you want some of the body of the candle to also be taken up by that area of interest. And if you come to an area where there's is an obvious area of interest, but there's a lot of wicks, try to see if you can put that area of interest to be consuming part of the wick, but also part of the body of the candle. So the area of interest that you see on the weekly time frame, those are usually the strongest. You could use a monthly time frame as well, but I don't use the monthly time frame. I really don't. The monthly time frame would put this area of interest more here. Right? You can use that as well. When I do my analysis, however, I tend to be more accepting of the weekly rather than the monthly. So you see how the time frames change where that area of interest can be. For me, I prefer the weekly time frames. Or that was daily. I prefer the weekly time frame. You could make it larger, but you don't want it to be too large. But so that's our area of interest on the weekly. You also have some smaller area of interest here. So you can, if you want to, you can place a rectangle there. But I would determine these, I would call these a more minor area of interest. The reason being is because price oftentimes breaks through these areas. But there are areas to note because when you take your trade, you can use these as your take profits. You're not necessarily going to wait until price gets all the way here, the weekly area of interest, because price could very well reject off of this area. Good, so those are our areas of interest. Now we have an obvious trend line here. So you want price to touch your trend line at least three times, 3 points. 1, 2, 3, 4. See? So you're just following the direction. Just following the direction. Now, so on the weekly, on the daily. Now this movement has already occurred. But tell me, based off of our previous videos, based off of my previous videos, on this entire chart, actually, let me do something else. Let me do something else. Let me give you guys options. Now you're gonna tell me what areas you think would be the best areas to take trades. Oh, we have a trend line here as well. Now, which areas, based on the areas highlighted, would you think would be the best areas to take trades? So you have here, 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 and here. So look at them. Tell me what you think. Now let's start off here. Let's go down a lower time frame. Now, like I said, we're swing traders. So we wait for perfect setup and we enter. Now this to me is one of the best entries. Why? Because we have an area of interest and we have an established trend line. Now, at the time that the price would have been moving, everything to the right here would not have been able to see. So let's try that. Oh, what happened? Okay, seems like we're getting some technical issues. Okay, set it up. Good. So this is as far as price as we would have seen. So we're looking at the charts and we see this. Now in real time, when we draw our trend lines, we want price to, in order to form that trend line, price has to touch two parts and then it should be about to touch the third point in order to confirm that that's a trend line. So what would have happened? We would have seen price do this, and we would have seen price come here, and we would have said, okay, let's see. Let's draw a line and see if price follows. So we would draw the line from here. I will draw it straight up, and we would wait. As price comes to this area, that's when it comes to the area and it rejects, that's going to confirm that it is indeed a trend line. We need the price to touch the area, to touch the trend line 3 times and reject. So once we get a rejection here, that would confirm that that's our trend line, and I would have taken a trade. I would have here. I'll place my stop loss under the area of interest, and I have taken a 1 to 2. Could be up to a 1 to 2.5 or up to the top of the previous high, because remember, we said that for bullish market, we have higher highs and higher lows. So this would be the high, this would be the higher low that was being created there, rejecting off of both the area of interest and the trend line. And so we expect if this price is going to continue in a bullish direction, it's going to make a higher high. So we know that at the very least, price should come to this area. And that's how we'll make it. Let's see what happens next. Let's go. And there you have it. So that's how price works. That's how the trading strategy works. That's how knowing how to put together your area of interest in addition to your trend lines and using them to your benefit. The best trades to take are trades where we know that price comes to an area, a particular area, and it rejects that area. So if it's a situation where we don't have any obvious trend lines, but we have an area of interest that price always reacts off of, and it gives a very strong reaction off of that area, that's a good area to take a trade. If that area is transected by a trend line, right where that trend line meets that area of interest, when price comes to that point and it shows signs of rejection, that's a very good area to take a trade. Right, so let's close this. So those are your areas. Those are your best areas to take a trade. I hope that clears everything, or I hope that gives you a better understanding of how to use your area of interest in addition to your trend line. So this is the example that we used just now. And again, price comes to this trend line. This is another area of interest here that you could also have used. It's a smaller area of interest. Because you see, as price comes to that area, you get a rejection. Right? It's a good spot to take a trade. And it comes close to the trend line here at this point. Doesn't exactly get to it. But what I would have done is after I've seen price get to that area there, I would have taken a trade like this. And it would have worked out. All right. So this is a good area to take a trade because as you see, when price comes to this area, it rejects. It rejects. So we have history of price coming to that area and rejecting. If you have taken one here as well, that would have worked. This is a bad area because there's no history of price rejecting off of this area. This is a good area because price, you can see to the left, when price comes to that area, it oftentimes rejects. Good area, great area. All right. I hope that clears some things up for you guys and join me on the next video.